Phil McCoy from Ameriprise Financial and the Mirius Group of Financial Advisors, Winchester Avenue, Martinsburg. Good morning, Philly.
Good morning, John Gilstrap. How are you, sir?
I am well, Phil. How was your weekend?
It was great. I did a lot of great things this weekend. It was wonderful. A lot of chores. I fixed the garbage disposal. I was proud of myself. I didn't have to replace it. I know. I was proud. I normally have to replace those things. It was leaking a little bit. Wife said, you better get on that. I tinkered with it, and as of right now, 3 days with no leak. So, happy man.
Was it the hose?
No, it was a little seal at the top of it that just for some reason rattled loose. Could be because I put too much stuff down inside of it. I leave a lot of work for that garbage disposal. Carrots don't belong in the garbage disposal, by the way.
Carrots, yeah, that's a good point. And never dump, like if you have like flour or something like that, never dump that in your disposal. It'll clog up everything. Grease is bad.
Yeah. But I think it just came loose a little bit. I took it off. I cleaned it, put it back on.
Look at you.
I was proud of myself. Felt accomplished.
Really, you shouldn't put much of anything in a garbage disposal. Scrape that stuff into the trash, and then just what goes in the garbage disposal is what you rinse off the plates afterwards.
Yeah, but I like to test. I like to test the limits with that thing sometimes.
And then put in some celery, man. You'll
Bill,
test it then.
Bill, how are you doing today?
I'm doing well, thank you.
Good to have you.
It's great to have this enlightening discussion. Yes.
Good to have you on the show here today.
Garbage disposal discussion, yes.
Disposal talk with Phil McCoy, man. Let's see here, Phil. We got the final trading day of the month and the quarter today, and what a difference from April 1st to June 30th this year.
Yes, sir, and it's been a good month. It was a good May. It was a good June. April started off terrible. So as you started the quarter, we all remember Liberation Day and those 3 awful trading days that followed, and then we started a recovery. And now on the S&P, and it looks like we'll reach that on the Dow today, probably, hopefully. S&P and NASDAQ, we've recovered our all-time highs yet again in just 4 short months, really. We hit those in February, and we recovered them again on Friday and had good momentum going into Friday. A lot of headlines that were all positive momentum, and we hit another one over the weekend with a little bit of relief on the Canada front as far as trade talks are concerned. So, this morning, all green across the board, it looks like. So positive news heading in for the end of the quarter. And that old saying, I wanted to talk about this a little bit because it kind of goes into, technical analysis and why we don't pay attention to it. But go away in May. I think a lot of people have heard that. You go away in May and then come back sometime in the fourth quarter. And had you gone away in May, that would have been a bad thing for you because we've had a really good run. And I'm talking about the S&P. We're up over 10%, I think, since the beginning of May. So we've had some positive momentum going forward.
You mentioned technical analysis. If you have a moment, please explain what technical analysis is when it comes to stocks and the market.
Technical analysis is really just looking at trends, looking at how markets have moved during certain periods or even during, like, say, the election period. That's a technical analysis. That, if we fall 10%, then you're likely to come back up 15% or vice versa. It has nothing to do with anything other than the movement of the stock market and what is likely to happen next. Now, sometimes it does prove out to be that it is correct. You talk about if you fall 20%, it's a good time to buy because now you're in a bear market and it's on sale. That's a form of technical analysis. But it doesn't take into play anything other than past movements and what happened last time markets did this or that. And, fundamental analysis starts with the breakdown of companies and sectors and certain asset classes and their profitability and their balance sheet. That's fundamental. And then there's technical analysis that really just looks at past movements. And sometimes it proves out to be correct. But we like to follow the efficient market hypothesis, and which basically says that technical analysis as well as fundamental analysis is never always correct, so you don't follow either one of those.
Now, we got some inflation news last week, Phil, that was not good.
It wasn't bad.
It wasn't overwhelmingly horrible, but it wasn't good.
Yes, it was. It kind of met expectations, and that was on the PCE, and I think it was on Friday. And while it wasn't necessarily positive in what the Federal Reserve wanted to see, it wasn't an end all. And because of that, and because of Jerome Powell's seemingly willingness to reduce rates fairly soon, our markets kind of saw that as a positive. Quite honestly, our markets took the inflation information we got on a positive note, quite honestly, because it is perceived now, and there's arguments to be had both ways, and I have no opinion, but it is perceived that tariffs have made their way into the inflation readings, at least some, and that they haven't had as negative impact as what we had thought, think back to early April. And even so, all this year, that's why the reason that we had fallen, it wasn't just April. You know, we weren't in that hole in April just because of Liberation Day. It was what led up to that as well, with widely expected tariffs. And our market started to struggle a little bit, thinking it was going to be a huge inflationary pressure. And now that, okay, it's made its way into it, and it hasn't been the pressure that we had expected it to be, which kind of opens the door a little bit for the Federal Reserve looking at employment numbers, looking at inflation numbers. There's like a 74% chance now that they cut rates in the fourth quarter. I think it was September that they had placed those odds at 74%. So while it wasn't great, it wasn't as bad as what we had thought, especially earlier on in the year. So it wasn't bad enough to hurt our positive market momentum and our overall perception that the Federal Reserve is going to cut rates sooner rather than later.
I noticed that my bank cut their savings rate from 3.6% to 3.5% toward the end of last week. I think 2 months ago it was at 3.7. I think a year ago it was, or more, it was at 4.35. So as this momentum is built toward rate cuts, the savings rates are coming down as well.
Yeah, and that's the bad side of it. So, you know, we talk in a positive light from market performance in those that may be borrowing or in the housing market looking to buy a home or borrow money for an auto. Cutting rates is a good thing. It's a positive thing for, you know, equity markets and for borrowers. Who it's not a positive thing for is cash savers. So if you're one that just says, hey, I've got a project or a child to put through school or an expense coming up that I've got to have an abundance of cash or risk-free rate of return, if you will, on hand, then you're not getting the return that you did not too long ago on that same type of deposit. So there's a negative side to it as well. But, you know, overall, from market performance to borrowers to spending, the idea that rates are coming down is a positive thing.
How much of the bad days around Liberation Day, the market performance, how much of that do you think was just tied to talking the market down, the media drumbeat that, oh my God, this is the end of the world? Do you think, and then now we're seeing the reality of business doing what it does now that the news cycle has changed. Do you think that's a big part?
I think it's a part. I don't know how big of a part. I think media and media momentum, if you will, plays on both sides of the coin, you know, to the good and bad. And that is all that we heard in early April, especially after Liberation. It's not just early April. Let me go back to that. It's all we've heard all year are the tariffs and the negotiation of the tariffs. And I think that plays a big part of it, too. We always say that we want transparency and we want to hear what's going on. But is there a point where it's too transparent, where we're hearing too much of the negotiation and we hear some of the wild claims or the threats, if you will, in that's all part of the negotiation process that absolutely scares us to death. And I think that it does play a role. It plays a huge role in it. If you just watch the nightly news, you're bound, and I don't care which station, it doesn't matter, you're bound to walk away scared to death and scared to death over money. And yes, it does make its way into our markets. On the individual investor side, hopefully the professional investors, the mutual funds, and the separately managed account, those that are managing billions upon billions of dollars, hopefully that falls on deaf ears with them, and your financial planners for that matter. It should fall on deaf ears with them as well. But to some extent, there's a lot of emotion that plays into that, and a lot of biasness plays into it as well. You know, whether you like the current administration or you don't like the current administration sometimes reflects in what you do with your investment or how you feel about your investments, and that's always a mistake. But you're 100% correct. The media does play a part in that, and it always has. Both sides.
I'm gonna push back on that for a moment because it's not the media that trades stocks.
No.
Phil, it's your people that trade stocks. It's the automated programs that trade stocks. It's the giant investment houses that trade stocks. And they were selling their stock by the bunches. The media reported on it. So, I mean, do we want to become the People's Republic of Korea because it's Trump? We can't report that people are selling stocks and the market's falling. The market was plunging. It was frickin' plunging. And that's what the media does. You report what's happening.
And the same
it's
thing.
Not just financial planners, and it's not just professionals that trading. So there's individuals that trade stock on their phone every day, and we look back at the meme stock, the meme craze with GameStop just a few years ago really shows the gravity of how much individual investors could do.
Yeah, there's individuals who trade stocks, but what percentage of the stocks that are traded on Wall Street are traded by individuals, and what percentage is traded by computer-generated programming and investment houses?
I don't know, but the computer-generated program, that's why I brought up the meme stocks, is sometimes triggered by individual trades. So it does play a role in it, and it has, and it does to both sides, to the good and bad. Like right now, I watched the news last night, and it was all about how much the market momentum. It was financial news, but the market momentum heading into the day and all-time highs, and are we in another bull market, and when's this likely to end, and the AI craze, and it makes you, as an individual investor, it makes you feel good about it. And beyond a shadow of a doubt, I guarantee we'll get a few phone calls this week where people that's got cash on the sidelines that wants to put them in, and it's probably been a mistake because we're yet at all-time highs again. But the euphoria of investors, they're feeling pretty good right now, and some of that is driven by the media.
Yeah, some of it is, but if media doesn't trade stocks,
well, we
report it,
and that's not the reporting I'm talking about. Of course, you report on the plunge that has happened. I'm talking about the talking head part of media that was the sky is falling. This is going to be the end of the world if Trump goes through with these or if you elect him. So I just think there's that kind of initial panic response that was a negative, dump it all, kind of ridiculous. It makes no logic. It makes no sense. Just dump it all and run away. And now I think the reality is seeking back in that, wasn't that big a deal.
I think that's low-hanging fruit, man. I think everybody's default is you blame the media or you blame society. That's what everybody goes to, right?
Phil, let's go back to what makes the market tick. And the longer I'm work with the market or familiar with the market, the more confused I am. We hear the market is a predictor. How far out does it predict? I'm looking specifically at this bill that the Senate is debating right now. It's got 3 or 4 things that pull in different directions of the market. The reduction of income tax, permanent reduction. The debt that they're going to be incurred, the increased debt, the social safety net that's going to be under threat. All things that should affect the core of our economy. Yet I get the sense the market is somewhat oblivious to the direction the big beautiful bill is going, and they don't show a lot of response as they go through the various negotiation stages. What's your read? I know you try to stay away from politics, but what's your read on how the market responds to what's happening on the Hill right now?
I think as it pertains to the big beautiful bill, as it's been called, the main part of that is keeping income tax fairly low. That's a market positive, and corporate taxes low. That would be a positive for the markets. And while it does focus or have some sort of, I shouldn't say focus, but pay attention some to our national debt, that's not the market concern that you would think it would be. It's rarely has it ever been a huge market driver, because if it were, then our market would be at all-time lows because our debt's at an all-time high every day, seemingly. So as far as the bill is concerned, it's more important to our markets, and only to our markets, that there's a certainty with the bill, and income taxes remain low and corporate taxes remain low. And that's not an opinion by me whether they should or they shouldn't stay low, but as far as markets are concerned, they do like that lower income tax and lower corporate tax because it equates to spending. and spending equates to good market performance. It almost has the same effect as low interest rates, because lower interest rates equate to more spending. More spending equates to green numbers in our markets.
So, yeah, that makes sense, and I think that's probably what a lot of us anticipated. But there's a third leg to that stool that you have not mentioned, and I mentioned very briefly, and that is the social safety net, which is right now under fire. Is that going to impact the market at all?
I don't know, to be quite honest with you, and I don't think as a whole money is that concerned about the social safety net. And this may sound like a harsh comment, but those that rely on social safety nets aren't necessarily those that drive market performance. So from that standpoint, while it's on the radar, I don't know that it's a huge concern of money overall.
Are you surprised?
And by money, I mean the markets.
Are you surprised that the events in Iran last week, last couple of months, but certainly with the U.S. involvement last week, really hasn't had much of an effect on the market? I mean, oil is at 65 now, which,
spiked up into the like 77, 78 range, but it came down quickly once it appeared to be clear that this would not be a long-lasting conflict.
Not greatly surprised, quite honestly, because there's always unrest in the Middle East, and we say this as a general rule of thumb, excluding China. When things happen overseas, it tends to be a 1 or 2 day market mover, and then we move past it. And I think we moved past that pretty quickly. And with the ceasefire that hopefully remains, with the ceasefire deal that was in place, what I was surprised about was our markets never they really didn't fall over the unrest in the Middle East to begin with. So when those bombings started, and that we had like a moment of red numbers that you can attribute to that. What I was surprised with, because it didn't fall, we then gave credit to quite a jump when there was a ceasefire agreement that was put in place. So I was thinking, well, wait a minute, if we didn't fall because of it, where's the bump? Why the green numbers? Because there's a ceasefire. So we seem to have a recovery for a fall that never happened.
Are we pricing in a rate cut that's probably coming in the near future? Is that why there's green numbers?
We're absolutely pricing in a rate cut that's coming in, and we kind of mentioned this last week. So even with there's some sort of sigh of relief if you want a rate cut. If it doesn't come in July, which it most likely won't, then we expect it to come, and I think it's September, where there's a 74% chance that the rate cut could come. But even if it didn't, there's almost a floor that's been put in, because the perception is that the administration is going to replace Jerome Powell anyway, and they're going to replace him with someone that's much more likely to cut rates than what he is, quicker to cut rates than what the current regime is willing to do. So even if they don't come in September, there's going to be someone in place that's almost assuredly going to cut rates anyway. So there's almost been a timetable that's been set that, okay, if it doesn't happen in July, which it probably won't, then it's going to happen in September. Most likely it will. But if that doesn't, regardless of what the numbers look like, there's going to be someone that's put in place that's much more likely to cut rates. So it's not going to make it past the first quarter of 2026.
Now, Phil, Jerome Powell is the face of the Federal Reserve, but he's not the only one. All the Federal Reserves tend to walk in lockstep. Two questions. One, when is Jerome Powell's term up? And the second thing, will there be sufficient turnovers to have the Fed work the way that the president would like to see it work?
It would, because a lot of those are appointed positions. But I think his term is up at the beginning. I'd have to do some research, but I think it's up in the first quarter of 2026, with the replacement being potentially named in the fourth quarter of this year, than him just being just role playing until his term is completely up. But that you're exactly right. It's not just Jerome Powell. He's just a mouthpiece. He might be the loudest mouthpiece, and he might have the most say in that group. But there's a lot of people that get in. It's not just one person making these decisions. He's just the leader of that group. my guess would be if you replace the leader, the rest of them would be replaced as well.
May of 26.
But Trump's already said, even though he would like to replace the Federal Reserve, but he's not going to do it until the term's up. Will all the terms be up in May of 26, or are they going to be staggered?
Powell's term is up in May of 26. The other one's staggered.
I don't know the answer to that. I'd have to look that up, but I don't know the answer if the rest of them, if their term is also up.
I believe they stagger. Yeah.
I think they're due as well.
I think that's just the Fed chairman's term. Phil, when they cut, they tend to cut in quarter, half, or whole increments, and you have to go back a pretty good amount of time to get a cut of a whole percent. But is that, do you know, are they restricted to that, or can you cut by like 0.3% if you want to?
I think they can cut or increase, just like the three quarters of the increase that we got in 2022. I think they can do it as much as they want or as much as they see fit. Most likely, especially with Powell, it's going to be a 0.25% cut. That would be the most likely scenario, that they do it slow and steady. But they did increase rates by 0.75%. And I think we got a 1% cut back during COVID. So that you can cut that much. I don't think they're restricted to it.
Yeah, I meant more like, can they cut by like 0.42%? Can they get as fine as they want, or do they have to stick to quarter, halves, and wholes?
Don't know that either. My assumption is that they have to stick to quarter, halves, or wholes because that's what they've always done.
Yeah, I don't remember anything otherwise. Powell, you're right. Powell does kind of, other than COVID, they like to do that 0.25% and then wait and see much of the time.
Safe movements, yes.
More of a conservative approach to cutting. Right. All right. Let's see here, Phil. I got a minute and a half left. Go ahead and plug the firm, sir.
You can reach us at 304-263-4343 or stop by and see us with an appointment at 1270 Winchester Avenue right here in Martinsburg.
All right. Now, football camp starts tomorrow's the 1st of July. That's football camp month in the NFL. Give me your Steeler prediction this year.
Man, I'm going to go with 11-6 with the possibility of 12 wins. You know, I'm always bullish on my Pittsburgh Steelers, and all of a sudden I've become an Aaron Rodgers fan. He's a good man.
Dylan's making faces like, "Whoa, are you out of your mind?" 11-6.
Good Dylan. I won't talk to Dylan right now.
You can put his headphones on. You can talk to him as much as you want for 30 seconds at least, anyway. Yeah.
No, I don't want to argue with Dylan. I like Dylan. No arguments with Dylan. I live in fandom. 11-6, baby.
All right.
If they went 10-7 with Russell Wilson, they should be able to go 10-6 with Aaron Rodgers.
That makes sense.
11-6.
Right. And I told Dylan you needed to have the worm in there for the Fun Friday nickname teams they were doing.
Yes, that's. I gave him props on that. That was a good segment. Yeah. People should tune in and watch that show more. Those guys do a good job.
I listened all the way till I lost radio signal, sir. Have a good day, Phil.
Thank you, guys. Have a good week.
You got 2 minutes of Phil every weekday morning at 6:38, replayed at 7:38, setting up today's market conditions. This is Talk Radio, WRNR Martinsburg and TV 10.